I think it goes without saying, you probably everyone here already knows this, but you know Chad, you basically are 1 degree of separation from everybody who's important in Silicon Valley, so FYI. So first of all, welcome. Again, thank you very much for attending. We have an outstanding group of panelists here today. I think I can summarize the 18 questions that we're going to ask in one question, which is how do I get acquired, right? Which is I think what we're trying to derive here for everybody in the audience. But let me verify that by understanding who is here. So founders of new startups, basically, raise your hand. Investors, seed, venture, other. Okay, got it. All right, so just FYI, this is who we're talking to. I think the format that we'll follow is similar to what we've done in the past. I'm sure you've been to these events in the past, and that is we'll try to start with the discussion on our own. We'll maybe take a few pauses at various points to take some questions, limit those questions at that point, and then try to proceed and get through the content. And then toward the end of the session, we'll try to leave more time for all of the other questions that you'll have. Again, my name's Harold. I'm one of the partners here at Oric. We represent lots of great early stage companies that would love to be acquired by folks like these guys. So why don't we go ahead and meet our panel. I'll let each of you introduce yourselves, but let me just say a word. Dave here to my right and I started in the legal profession together, so if we spontaneously start talking about legal stories, forgive us. But anyway, go ahead, Dave.
Well, hi, I'm Dave Sabota, and I actually like to hide the fact that I'm an ex-lawyer, so thanks for giving me I'm at Google. I've been at Google about 9 years, and am in the corporate development group.
So I'm Aaron Crum. I'm actually a VP in the corporate development team at Yahoo. Before that, I had the great pleasure of being a colleague of David's at Google Corp Dev as well.
Hi there, I'm Jacob Mullins. I'm the founder and CEO of a startup called Exitround. We're a marketplace for acquisitions for buyers and sellers of companies to meet. And we can talk more about that.
I'm Jessica Borelli. Is this on? That's me. There we go. I'm Jessica Borelli. I work in corporate development at Twitter, where I've been for almost 5 years. And before that, worked briefly in venture capital.
Okay, well, thank you. So the topic again today is talent acquisitions. I think we're all seeing and reading about the trend of very young companies that are proceeding on their own and then end up being sold to companies like those represented on this panel at an early stage in the company, either after their seed round or even before any financing. And the idea again being that these companies often see outstanding talent in those companies and see acquiring the company as a method of getting at that talent. So why don't we start by thinking about the market and understanding what we're seeing generally out there from a more objective standpoint. And maybe Jacob, if you could talk a little bit about, given the perspective that you have on what's going on, what you're seeing, the numbers of deals, are we increasing these kinds of deals, decreasing? What's kind of the general market look like right now?
Sure, so I can give one point of view of it, but I'm sure these guys have a good point of view too. So Exitround, we started in March, so my data point, day zero starts in March. And we're, like I said, a marketplace where we connect buyers and sellers of companies. On one side, we have about 600 buyers who are interested in buying companies that range from other startups who are interested in looking at acquisitions as a way of growing, to very large publicly traded companies, both inside of tech and also outside of tech, who are interested in looking at startups in order to kind of grow. On the seller side, we have about 500 sellers that have signed up to sell. It's an anonymous marketplace until it's double opt-in. So anyways, that's a little bit how it works. But I mean, we've been seeing a pretty strong growth from the day we launched. In the first 2 weeks, we saw about 100 people on each side jump in. So I think there's certainly an appetite for the talent acquisition. Today, I'd say 85% of our companies are kind of talent acquisition candidates. The quick kind of average profile of the talent acquisition candidate within our marketplace today is a team of 7 people. 5 of those people are engineers or technical talent. They've raised on average $647,000, and 1/3 of those companies are outside of the U.S. So that we're seeing interest, or at least on the seller side, from India, China, UK, and Israel. And from within the U.S., about 40% of our group are in San Francisco, 40% in New York, and 20% kind of everywhere else. On the buyer side, what we've seen is just there's a pretty healthy appetite for people with strong technical chops. And I think gone are the days when when acquirers that we've seen at least are buying companies for pure talent, like, oh, you know how to code in Ruby, we want you. Now there's definitely a need for a product fit, and these guys can probably speak a lot better to that than I can. But making sure there's a strong product fit, because these guys want to make sure that once an acquisition happens, you're there for a long time, and everybody enjoys working together for the future. Any other kind of data points? I think just generally it's pretty robust and a lot going on.
Okay, great. Why don't we then jump into the area of how do we even get to this kind of a deal? And I think it would be great to hear from Jessica and Aaron and Dave about just the process internally, to the extent that you can talk about it at each of your respective organizations. Are we seeking these kinds of companies explicitly? Is that an objective that's on the list of goals that we have? Or is it we are looking at various sectors and companies, we see certain things, and all of a sudden it becomes more of an acquisition of a talented team because it doesn't look like it's a product that's going to fit into the system that we have? So maybe, Jessica, if you could start by just talking a little bit about what the process is like internally and how we get to these kinds of deals at your shop.
Yeah, absolutely. And just to build on what Jacob was saying, in general in the industry, I just think it is such an exciting time to be working in technology. So for all of you building companies, I'm sure you feel that energy too, and for those investing in companies. And you touched on some of the broader market dynamics of this interest in exceptional technical talent with product vision. That's something that I think extends not just to tech companies, but now you're seeing other sort of non-traditional tech companies looking to find the best and brightest teams with product vision to supplement what they're building. So when it comes to running a process, I would say there's a bunch of stuff. We can go into various levels of details and what that looks like. For us, we always start the conversation by trying to understand what a team set out to build and what you're passionate about. So in many cases with talent acquisitions, you end up valuing the fact that this team is exceptionally talented. They have a lot of experience trying to solve this problem. They took a swing at it. The existing product may not have knocked it out of the park, but is there a fit for them to come and tackle the same challenge on a bigger platform, joining a company like ours or any of the other panelists? And so when we start a talent acquisition, that's the very first conversation, which is, what did you set out to build? What idea excited you so much that you quit your job, you recruited people to join you, and you raised money to tackle this vision? And we try to figure out in that first conversation, are we interested in tackling that same problem? And in many cases, that's where things diverge. It turns out you are super interested in building this standalone product that is, really focused on this set of features, and that's kind of different than what we're trying to tackle. But in many cases, you may find teams, and I can give a few examples here. One we bought just over a year ago called Cabana. When we got to know that team, what they were passionate about was building a platform where it was easy for developers to build mobile apps. And as we got to know them, we thought about what we wanted to build in our own platform and what we call Cards, which is an initiative where partners can build more interactivity and more content into a tweet. And so we got to know the team and we understood what they had built in their previous company and their expertise and their passion and how well that aligned with an open initiative we had. That's where that first conversation began to feel you know what, let's actually run a process here. But in general, what I would guide you guys to think about when you do run these processes is start the conversation with all of those big high-level points. What are we passionate about building? What do we care about? Before you go down one level deeper into, great, let's set up tech talks and interviews and talk about a term sheet. Don't go into any of that until you have the high-level alignment around, we're excited about building this, and that's a priority for this company, and we know the leadership there, and there's a lot of alignment in what we want to go and do together. So that's where I would say you start the conversation.
That's great. Thank you. Aaron?
Yeah, I would sort of piggyback off a lot of those comments. I think that's obviously a very intelligent and sort of thoughtful process, and in many respects, I'm guessing all of us sort of will reflect that in our process as well. One of our favorite questions to ask when we sit down is, what are you really proud of? Tell us what the problem was that you solved that you're really proud of. What is it that sort of the team threw an impromptu party after they solved this problem, right? And then the other half of that problem, that is sort of where have you failed? Like, what is your biggest failure? Like, don't be afraid, tell us, because we're not going to hold it against you. Like, we want to know where you've hit sort of the wall. And I think all that goes to, those are two questions that we love to ask, and they go to sort of like, what are you passionate about? What problem are you trying to solve? And then, you know, like, we can be, that conversation very naturally will evolve to, like, what could you do at Yahoo, right? Or any of the other of our panels, right? So, you know, and I could point to examples too. Like, one of the ones that I'm most proud of that we did in the summer is an acquisition of a company called Zobni, right? Which was an inbox sort of scanning company. And that, like, that's Yahoo's wheelhouse, right? Like, most people have Yahoo Mail, you know, and we need to sort of make sure that that is a feature set that is super robust. And we need teams that are super passionate about, like, solving email, solving context, solving those sorts of things. So that's just one example of how, like, a conversation will go from, just tell us about yourself, tell us what you're passionate about, tell us what you're interested in, what you're solving, what you're not solving, where you've gotten hung up, what you're really super proud of that you don't think anyone else in the marketplace gets or has solved. Like, those are the conversations that will then lead to, okay, now it's time to start understanding, you know, what your financing looks like, what your expectations are from a price perspective are, what I think is fair is from a price perspective. Like, we will get to all of that, but the first conversation is exactly as Jessica said. It's like, what are you working on and what are you passionate about?
I agree with everything that Aaron and Jessica just said. I'll just add 2 points, which are kind of a layer over on top of both of that. One is the definition of what a talent deal is, in my mind, isn't binary. It's a talent deal or not. It's a continuum. So, you know, there's no deal that Google has ever done where the talent hasn't been important. So in some ways you could say 100% of our deals are talent deals. And we often will interview all of the team, or at least senior members of the team, even when we love the product and we love the business, we also want to make sure that the talent fits. And so it's a definitional thing to even try to figure out what is a talent deal and what's not. And the second thing I'll say is that talent deals are actually a horribly expensive way, from my perspective, of bringing on great talent. Even these cheap talent deals are 10 to 15 to 20 to 100 times what you would pay an all-star recruiter to recruit similar talent coming in. That said, it's a necessity in our business because some of the most talented folks are in great startups, and Jessica and Aaron are bidding to buy their companies, and if we don't bid along with them, we're not gonna get these folks. And so
we're the inflationary pricing pressure.
But our primary way of bringing in talent to Google is through we have thousands of recruiters literally calling up people and friends referring friends, and so just wanted to layer that over on top of the rest of the discussion. It's a wonderful. You know, a lot of our deals are talent deals. I wouldn't be here today if Google didn't do talent deals, probably. So it's a wonderful thing, but it's certainly not our most efficient way for us, from our perspective, to bring on talent.
Yes, Jessica.
Yeah, I would just build upon that and say one of the things you have to do, obviously, to justify why is this team so much better than, like, what we could otherwise recruit. You have to find a really specific deal thesis. And this is true anywhere on that spectrum, from pure talent to, hey, we're buying an actual business, to somewhere in the middle around technology or actual assets. And that thesis is something you as founders will craft with the corp dev team, and really importantly with the engineering or product sponsor on a deal. And that thesis comes back to that very first question, like, what are you passionate about building? And how does that align with what our big initiatives are? And then our job on the corp dev side is to try to, like, make all those pieces fit together. So it's, you know what, this team is exceptionally talented, like, the leadership has worked together for like 5-10 years, they come out of this industry, they have design leadership, they have engineers of this profile, front end, back end, mobile, they've got Android expertise, and they're really good at doing this, and so we're gonna have them come here and tackle this specific initiative with these specific goals, and we think that provides a lot of value to the company. And so our job, oftentimes behind the scenes, is to work with you as founders and our internal teams to, like, craft that actual thesis around why this is valuable enough to justify paying beyond talent, paying beyond what you would pay to hire someone.
So maybe we've already kind of addressed it, but I just want to understand, you know, let's say we've engaged now, the founder of a team is engaged with one of you or each of you around a potential talent acquisition, and it looks like that's what's going to happen. In your recent experience, what have you seen have been the major kind of hurdles or obstacles in the next step, which is that stage of diligence, of kind of working through and making sure that there is a deal? Before we get to the legal stuff, before we get to the term sheet, are there any big hurdles that the founders are going to encounter that maybe you can talk through, or stories you can talk through that might be helpful here?
Well, I'll start this time. So I think Jessica hit, I'd say two things. One, we want to evaluate the talent, which seems very obvious, but we'll look at resumes and we'll do interviews. So that's from the Google side. And then, and Jessica touched upon this too, from the company we're talking to, we want to make sure they're passionate about what they're going to do at Google in our case. And if they really want to be standalone and have a vision for their own product, that's great and wonderful, but that's probably not going to work for us if it's a talent deal, because they're going to be asked to work on maybe similar but not the exact same things. And so we try to sell them on, you're going to have a scale and an audience that would be beyond your current ability as a standalone to work on what you're doing. But so we just need to figure out if there's a fit on both sides, essentially.
So I would add, Dave referenced earlier, there is this sort of stratum of talent deal, right? Like, it's a label that is like too often applied, in my opinion. And most of them, for us at least personally, are not these sort of pure form talent deals, right? They're not this like, that's a great team, let's have them drop what they're doing over there and start doing something over here, right? So that early stage diligence for us, to return to the question, has a lot to do with like, what exactly have they built? Right? Like, what is on the back end exactly? I can tell, I can see the front end myself, it's easy enough, but what exactly is on the back end and what is behind the curtain, right? There is this, obviously we're not out there to find people's trade secrets. What we're out there to understand is like, is what's in the back end robust, or is it sort of, less so? Right? Because as you all know, there are multiple ways to solve a problem, and the question comes in, sort of how robust is it, how scalable is it, all those sorts of things. And now, so I'm starting to talk about sort of a more traditional acquisition, but I think to Dave's point, the Zabi example earlier, like that was not it's a talent deal. There's no doubt about that. Like that team is critical to our ongoing success in comms, but like there are clear technical things that we're going to need to know up front. That's for sure.
I would add, in terms of trying to understand the process of actually getting to a term sheet, like how do you go from these conversations with corp dev to actually getting a term sheet? I don't know if that's always well understood, but I think for us, there's 3 big milestones in that process. The first is that like conversation around high-level alignment. Do we care about the same things? Is there fit in terms of general interest, passion, and our priorities and what you want to build? The second is finding a sponsor. So internally, corp dev in our case will never get a deal done where like corp dev is the sole person championing it. So my job is to like use my own judgment to find the best companies and match them with our internal priorities. But then the very next meeting after you meet with corp dev should include a senior person on engineering or product. And for us, that person we will work side by side with, but he or she will need to, in our case, make the case for this acquisition alongside corp dev. And sometimes deals fall apart just because, hey, we've got high level alignment, like we're interested in the same things, but if there's no one on the engine product side that's willing to champion it, it's unlikely to make it all the way through the process. And so that's probably your second meeting, which is one with head of engineering or product with the right leader. And then the third is some initial way to vet the team. And so that could be interviews, but oftentimes before you get to an interview process, you come in for a tech talk. And like tech talks are like, it's a friendlier and easier way to kind of get to know our team and for us to get a sense of the technical depth of a team before putting them in front of like whiteboards for coding interviews. It just sets a much better working dynamic and kind of puts people at ease and lets you exchange important information about the quality of the talent. And so those are, I would say, are the 3 steps that you have to get through, and then the corp dev team normally has enough to make the first case for an acquisition and begin then talking like preliminary terms.
I kind of have a follow-on question, because I talk to a lot of founders and oftentimes they ask, at what point do I share information, like sensitive information? And it's, should I expect to have an NDA in place? Should I expect to have an LOI in place? Should I expect for there to be a term sheet? And they're concerned both on the technical diligence, like how deeply do I go into the technology, but also at what point do I tell you who all my employees are for fear of either poaching or just it's really disruptive for the team. And so at what point do you know that you guys are kind of, at least starting to go steady, at least at a point to kind of create a new, disrupt the norm, I guess.
I always, for my first meetings, tell the company we're talking to, I don't want an NDA. I don't want you to share anything confidential with me. Talk to me like I'm a reporter, and then let's go step by step and develop some trust and see if both either and both sides are serious, and then get NDAs in place, and then if and as necessary, bring in a clean team, which is. Google, and Yahoo and Twitter are all very well versed with good lawyers advising us. We don't want to be exposed to trade secrets of target companies because that hurts us. It can then expose us to litigation. It can cause us to not have really smart engineers at Google work on the same project because they've now learned stuff they shouldn't have learned. So we'll bring in a clean team of engineers, which are engineers that don't work on the problem at Google, and they will talk to the target company, evaluate their chops, but then don't share anything other than the results of the evaluation. They won't share what they learned, they'll just show the results of the evaluation with the rest of the Google to help us decide whether to move forward. And that way and they'll keep their notes in separate workbooks, and everything's cordoned off, and just to make it real clean. But I know Twitter and Yahoo do similar practices as well. So.
It's a trust building exercise. There's no doubt about it, right? And as Dave suggested, like the first conversation is almost a hallway conversation. What are you up to? From there, it's a trust building exercise. And honestly, we can be flexible around kind of your sensitivities, but my thinking there would be like, you are there's a trust building exercise, and unfortunately you're gonna need to take some level of risk as it relates to the disclosures that you make. We're not out to steal your trade secrets. Like that's just, and everybody else that's up here, are trading on their reputation as an acquirer, right? And it's easily tarnished and hard to sort of regain, right? So that's not something that we're interested in doing. We do need to know who your team is at some point at the right time. Right? We do need to know what you've built, right? Not at the sort of algorithmic sort of trade secret level, but we need to understand what it is that you've built. And hopefully in that process, we're walking you through a process that sort of builds trust, right? You've talked to me and my colleagues, you've talked to our relevant sort of product and engineering, and you're seeing a level of interest and a level of sort of heads down thought about what you could do at Yahoo or any of the other acquirers up here. And hopefully that is sort of bringing some trust into the game, right? At the same time, we can begin to parallel track conversations around, like what your level of interest is, what our level of interest is, what we see you doing if you were to come. We can begin to sort of have those parallel track conversations and build a little bit of trust. Is it a risk-free exercise? Like I'm kind of a frank salesman here. Like I don't think so. No, like I think you're eventually going to we need to know your teams and what their backgrounds are. There's no getting around that. Right. And we'll be flexible around sort of your sensitivities. Right. We don't have to do interviews before we sort of get the deal approved. It makes life a lot easier for everybody, and frankly, I think it makes it a better outcome at the end of the day. I'm much more likely to get a deal approved if I've gone through your team and we've had interviews and we have all that feedback.
Great. Jessica, just a quick follow-up on your earlier point about having a sponsor. Is it helpful for the team to have identified that person on their own and to try to have initiated that conversation and perhaps to have that be the focal point to then involve the development team, or does it not matter?
So to the extent that you can build relationships inside the companies that you might be interested in joining, you totally should. That might mean you're meeting the heads of engineering or product for initiatives that overlap with what you're building at conferences. It may mean you correspond on Twitter. It may, however you can build those relationships. In some cases, that's just not always possible, and it's the job of corp dev to help make that happen if you start running a process. So I would say it's always to your advantage to build those relationships because again, The deals, like when stuff comes inbound, what tends to be a really strong signal that this could be a match is when my engineering or product colleagues send me a deal and are like, I'm really interested in this. Then I know, great, we've got high level alignment. Like we've already got that first thing checked. And so those relationships help, but to the extent that you can't meet everybody, you can use corp dev to then run that process internally to figure out who the right person is.
Okay, great. Let me pause and see if there are any questions from the audience on these topics. Yes?
Question about transparency when you're looking or evaluating companies, and whether or not you have a mindset that you're going in that this is an Acqui-Hire and you're going to, you're going to kill the product or you're suspectful. How transparent are you about that, and how does that impact the valuation in terms of negotiations and all that?
Good question. The question is, how transparent is the potential acquirer in the conversations about whether this is an Acqui-Hire? So essentially, when does that get communicated?
I try to be as transparent as I can, as early as I can. So sometimes the first meeting we don't know what it's going to be, you know, whether there's valuable technology, whether we can actually migrate the product over. And so, you know, maybe the first meeting we don't know, but as soon as we've had our internal huddle up and we've decided, hey, we love the team, but we just can't use the product or technology, then I'll immediately tell the CEO, because it does me no good to continue down this path. And then, you know, at the end of the day, we've got a very big price difference, because talent deals are cheaper. We won't pay as much for a talent deal as we would if there's valuable technology business. And so you need to, you know, you're just wasting everybody's time if you're not upfront about where your head is.
Any other thoughts?
Yeah, absolutely. I mean, you just want to be as frank as possible, as quickly as possible. And that specificity continues throughout the process. So by the time you are finishing the deal or somewhere in that process, you should know, what are we working on? Are we continuing the product? Are we leveraging the technology? Who specifically are we all working for? And you should know that person really well, because at the end of the day, a lot of these decisions, especially for talent, have to do with where does this team want to spend the next chapter of their career, and where can they build something meaningful, and where can they professionally grow. And so as much as you're focused on initially, is there alignment? Do I have a sponsor? What are we talking in terms of price? Am I paying back investors? Is there a return? Is this mostly just job offers with a finder's fee? Like, you'll figure that out quickly. And then you need to figure out those secondary questions to the point that you should know your roadmap before the deal is closed. Because the last thing you want, and this is something we've learned along the way as we've grown up as a company and as a corp dev effort, is for a team to get there, have a high level sense of what they're doing, but like no 30-day, 60-day plan. And just to set these things up for success, what we found is making sure teams have that first launch they're going for, the like impromptu party that you throw for, like, you know, the stuff that excites teams, that should be known, so that like they get there, can knock that out of the park, and then you can also show, like, listen, we said they were going to do this and they knocked it out of the park. And like those things just become like momentum building. And so in terms of how specific you want to get and how frank you want to be with corp dev, that should just keep going into more and more and more levels of specificity as that process goes on.
Yeah, I can say these guys are the most well-oiled machines for buying companies ever. There's a lot of situations where it's really vague and people end up going way down a process and waste a lot of weeks and months, and then it falls apart because the price was so far off that, you know, it's just a waste of time. So I'd say I agree. You know, try to push them to get as specific as possible, as early as possible.
Hey Jacob, on that point, do you have a sense for just kind of market success rate right now that you're seeing for these kinds of acquisitions as you're making these kinds of deals come together? Is, you know, how successful are they at this stage?
From closing, or what do you mean by
From
success?
introduction through, you know, actually getting into.
It's pretty low. I don't know if I have a specific number, but it's, you know, I don't know. From what we're seeing, you know, we see such a wide swath from intro to close. If I had to put a number on, it'd be like 1 to 5%. I mean, maybe that's even high. It's still pretty. These guys probably have much higher percentages for their close because they're coming in with a more specific purpose, but it's still very, very difficult. But again, find the internal sponsor. I think that's the big thing. If you have a CEO or a GM of a product group saying, we need this company, that's gonna do a lot.
Okay, great. Any other, yes, in the back there.
Can you discuss kind of framework for valuation in regards to intrinsic value versus market-driven value and such?
All right, now we're getting to the real stuff. This was on the list. All right, let's go right to it.
The lawyer over here is pointing to it. So.
The question is the framework for valuation in these kinds of transactions.
So I tell our team that I'm very proud of the fact that I went to the University of Chicago. Like really, I try to be of this analytical mindset. And I tell my team that if I told the University of Chicago what I was doing and how I was valuing companies, they would ask for my diploma back. Which overstates it, obviously. Like, we do try to be very data-driven and robust in our approach, but the simple truth is, like, all the stuff that if you have an MBA, you went in and learned about NPVs and all that stuff, especially if they're sort of negligible revenue or pre-revenue, it kind of goes, like, right out the door, right? What we do have is we have a number of benchmarks that we look at. I'm not going to get into all of them, but there are some obvious ones. The number of engineers and the sort of some form of a multiple per those engineers or per head or designer or those are the obvious ones, and you sort of hear those talked about in the sort of blogosphere, right? We're also looking at, to Dave's point earlier, like this is a very expensive hiring exercise, and we're mindful of that, right? We're mindful of kind of, if this person came in through the normal channels, like what would they look like? And then we're mindful of kind of what they would look like there. Obviously, one of the nice things about being in our position is we see a lot of comparables, right? We see a lot of comparables for companies that even though they're they may be pre-revenue, we know exactly kind of how many users they have, how many page views they have, how many sort of like dailies, interactions they have, those sorts of things. And we can begin to sort of understand how they compare versus some of those comparables. And then we can think through it from a comparables perspective. And then we can get creative, right? And this is where it gets a little bit more art than science, but we can get creative in the sense of being data-driven and sort of understanding, okay, what's the value to Yahoo? Right? If we were to rebuild these feature sets on the Yahoo platform, what do we think happens to our users from an engagement perspective, from a time on site perspective, those sorts of things? And that's hard. Like, I'm not going to lie to you, it's hard and it is art rather than science. That's my joke earlier. But we work really hard to be data-driven about it and use many of those factors to sort of triangulate on value. So those are the things that come to mind.
I would add too, when you think about those like major points that come in a term sheet, when you think about price, that has two components, obviously, like the actual purchase price for the company and then the additional retention compensation for the team. And I think our job is to try, and also vesting, which is sort of a function on price too. Our job when we develop this deal thesis is to try to match the deal thesis then to, well, if this is the value that we believe we're getting, how do we then price that and put that into terms? And so if the value of the deal is that this team comes here and builds something over time with us, and let's just say they all left on the first day, well, then let's say we don't actually obtain much value in the case that the team doesn't stay, therefore it has to be earned over time, and that's how you kind of can justify vesting and working together. When it comes to that breakdown between what you're actually paying to the company and what you're paying for each of the folks on the team, that's something that you should just think through in terms of what that price looks like, and also cash versus stock, and how, in thinking through to what extent you think there's potential upside or risk in stock is obviously another function on how you think about price. But in addition to what you said around comps, which I'm sure all of us just kind of watch whenever stuff is announced to try to figure out what other companies are paying, but each of us also has done enough deals that we have our internal numbers on all of this. The other thing we look at in terms of, in addition to engineers, designers, product folks, and what you pay per head, we try to make the case that if you have a team coming to join and work on this specific effort, remember we talked about roadmap and launch something, we try to have that to the level of we will be able to launch something 1 quarter, 3 quarters, 1 year earlier if we do this acquisition, and then we try to ask, what is that worth to us? Or does this fundamentally de-risk something that's highly valuable to us? Or I'll ask our teams, hey, how long would it take you to otherwise find a team that's this expert? And if they start saying, you know what, to find a team that has 6 people with this very deep expertise in this area, we're talking a year. Then you're okay, well, we're gonna be able to build something a year earlier. There's value to that, and that's how we begin thinking about price.
Great, Dave, any thoughts on that?
The only other thing I would add, and I agree with everything both Jessica and Aaron said, is that there's a huge beta in terms of the average price per head we pay, and we look at all the data. And so if it's 3 guys who or gals who are 1 year out of their undergrad CS and they've started a small company that hasn't done well, they're going to get a lot less than senior PhDs who have demonstrated that they're the thought leaders in a particular place. So if you hear these averages, don't get too stuck to them. You might hit above the average, you might hit well below the average. The standard deviation is quite large.
I would also, I would add to that point, these benchmarks, like I would be a little bit careful about kind of the numbers that are out there in the ether, right? It's not that they're invalid, it's just that you're probably missing the nuances as it relates to breakdown between sort of equity and debt and, and retention, right? There's a lot of nuance that goes in, and sort of the headline number is sort of easily misunderstood.
Yeah, I can tell you the $1 million a head is only true in TechCrunch headlines from my perspective. So.
And I would say, well, those initial conversations, remember we talked about high-level alignment. I think somewhere early on in the process, it's actually useful to begin painting some pictures around price and what your expectations are. And one way to do that, without talking numbers prematurely, is just to frame how much money has been raised at what valuation. And you can be, like, the corp dev team can either give you guidance or you can set expectations, like, listen, like, we think the valuation that was set a year ago is pretty fair. Like, we're looking for something in that range. Or, you know what? Like, it's really important to us that we pay back our investors with some return. But bear in mind, that could be less than the most recent post-money valuation, because the team and the rest of the cap table could get squeezed. But, like, that maybe sets the price threshold lower, and then they could be compensated on the retention side. And so if you know where that threshold is early, I think having that conversation, or you know what, like, we really think the most recent post money was this, and we feel like we've created a ton of value since then, so we're looking for some multiple on that. And pretty quickly the corp dev team could say, like, that's super rad and you should totally believe in what you're building, but that, like, value doesn't align with the way, like, the value proposition we would receive for it. And then you cannot waste your time in, like, tons of additional meetings. And so I would encourage you to find ways to ballpark on price early.
Let's jump to the deal terms, since I think that's come up now. So we've gone through the engagement process, we've gone through diligence. We're now on basically trying to put a deal together. The specifics of that are often some kind of cash consideration potentially, some kind of stock consideration potentially. And then we talk about retention. I think it's worth kind of drilling down on what really that means. Can you guys speak to what are the main tools that the founders should expect to encounter in terms of how these deals will be structured? Are we talking about putting some portion of the consideration into a future contingent payment type of structure? Are we talking about taking shares that the team already has earned potentially at their current company that would have been translated into stock in the new deal being re-subject to some kinds of forfeiture? What are the mechanisms that are out there right now that we should be thinking about?
Yes, to those questions. So there's, in my mind, 3 buckets, and Jessica talked about this, of compensation you will get. The first bucket is a payment to the cap table. The second bucket is, we call them stay bonuses at Google. They're always cash at Google. We don't do stock for the stay bonus, and that's payment contingent upon you continuing to work at Google, typically over a period of 4 years. And then the third bucket is just, on top of all that, you're going to get your standard Google offer letter, which is going to have a base salary, a bonus, RSUs, health benefit, and all that kind of stuff. With respect to the first bucket, the payment to the cap table, we do sometimes, depending on what the cap table looks like and the situation, ask the founders to unvest part of their shares, and then they have to re-earn that vesting over a period of some point of time after closing. And then the second bucket, which is the stay bonuses, we look at whether we do the math and try to make sure that certainly a majority of the consideration we're paying is on the back end. To Jessica's point, if the team quits on day one, we've just lost a bunch of money because the talent deal hasn't paid for itself then. And then the last bucket, the employment stuff, tends to be more formulaic and less negotiated, because it also tends to be the smaller overall dollar amounts out of the 3 buckets.
Aaron?
Yeah, so our structure is very similar. It's no great secret. Like, so we are doing cash deals right now. What we are actively, I won't speak for the other company, but Yahoo is actively buying back its stock in the market right now. You may have seen this, right? So it's a little bit incongruent for us to be doing stock deals while we're simultaneously buying all that stock back. We have all this cash. We're going to be putting it to use. We have coming liquidity. We're going to be putting it to use. So we're a cash buyer. Our retention bonuses, our stay bonuses are structured very similar. They're paid out over some period of time. They're cash right now. The way we've got it set up is that we're doing cash pools in the same Google sense. We will look at the payouts as it relates to the founders in the same way and do holdbacks as it relates to that as well. So nothing new or different from that perspective. I would say one of the questions was like contingent payments or those sorts of things. So earnouts. I would say that we are, we can be thoughtful about those sorts of things. I would tell you that there's probably a strong negative bias towards them. And the reason being, and from my perspective is, and the advice that I would always give to both the founders that I'm talking to as well as sort of our own management team is you are basically, there's a high probability that you're buying a point of contention down the road whenever it comes, 2 years, 3 years, whatever that case is. Because whether they're financially oriented or technologically oriented, like development oriented, there's always something, right? There's a dispute down the road that it isn't good for the team that just came in, it isn't good for Yahoo, it isn't good for sort of the product that's trying to get built, it's disruptive, right? But there's always something. I didn't get the server time that I was expecting if it's development oriented. I didn't get your sales guys were not co-selling my product in the same way that I had expected or that we had talked about. And that's just disruptive. That's a problem, and I usually seek to avoid it by saying let's find another way to solve this problem. Right? We can be thoughtful and creative minded, but the negative bias, I have a pretty strong negative bias against that, and I'll speak from, I don't know if it's changed, but speaking from my past experience at Google, I dare say it's the same.
Yeah. Jessica, any thoughts?
Yeah, I think they covered all the stuff on price. The only other insight I would mention is just in terms of knowing what this process looks like. I talked about 3 major milestones between first conversation to term sheet. If you've been in those conversations for more than a month, it's taking too long. And that's where you can try to add urgency from your side by either just asking specifically, what's this internal process look like and what other things are you trying to resolve? Or if you have a financing offer or another M&A offer, that can push the urgency for the other team to make a decision. But I think putting teams in limbo is just a nightmare for founders, and it's not a great process on our internal teams either. So pushing for that to be under a month from all those high-level conversations, a tech talk, some initial vetting, alignment to a term sheet is what I would say you should target. The term sheet, I think you guys probably know, you're oftentimes signing a term sheet and you're signing a letter of exclusivity. And the letter of exclusivity is legally binding and says you're only going to be negotiating with that one partner. And that's important because the point that you sign a term sheet, to this earlier question of what percentage of deals actually make it all the way through, if you're signing a term sheet, there's a very, very high likelihood at this point, we're going all the way. We've got alignment on what we want to go and build, we've agreed on price and all these other terms, and we say we're only going to be talking to you from here on out. And so then, once that term sheet is signed, then you have an additional several weeks, or it could be months, depending upon how complicated the deal is, but both teams are very incentivized from the moment the term sheet is signed to run all the additional process to actually get the deal, the actual purchase agreement, signed and closed. And so just thinking through, those are kind of the major milestones. And hopefully, if both teams are doing their job right, the term sheet has all the major points in it. So by the time you get to the purchase agreement, which is just a much bigger legally binding document, you've already front-loaded all the big points. And so what's left in there are smaller clarifying points and things that are just you can generally agree to help run that process quickly.
That's great. Okay. How well have these retention terms worked in practice for you guys? Is it something that you put in place, these kind of milestones or these payments down the road, and you're pretty certain that the team is going to be there. Are you seeing that in reality?
I would say retention, in my opinion, has less, what I've seen, has less to do with did we structure everything perfectly and did we price this perfectly. It has so much more to do with, is this team have a sense of ownership over an initiative that is like high impact for the company, and are they like empowered to do what they were excited about? And that's where like you're reminded that corp dev is a lot of this process is like one of emotional intelligence and one of like really getting to know people and trying to set them up for success. Because the truth is, every one of you in this room building companies, you have a lot of options for what you want to go and do. You can build another company. Like the market for tech talent right now, like you could probably work at a bunch of different buyers. And so the truth is, if you end up in a job where you're not that happy or engaged, even if you have a pretty strong retention package, you're probably not going to stay. I mean, you know, because you have other options which are probably financially exciting. And most of you started companies because you were so passionate about building something. And so when we think about retention, it's our job to be like reasonable and set things up in a way that's like logically sound, like they will receive this much value over this period of time. But whether people stay or leave, I think has far more to do with whether or not they're engaged in what they're actually building. And that's why it's so important in the process. Get to know who you're gonna work for, figure out what you're gonna be building, and make sure you have like support from that executive team to achieve those types of things along with price investing.
Any other thoughts on that? No? Okay. Questions on this topic? Yeah.
I have a question. You mentioned holdback a few minutes ago. And holdback is usually a way to protect the acquirer in case of patent problems and so on. Why do you use holdback in the case of an Acqui-Hire type scenario?
Yeah, so I'm perhaps mixing terms, but David used the term sort of they're asking founders to revest a piece of their equity. That's effectively what I'm talking about. I'm talking about a founder's holdback, which sort of it creates the same effect of sort of revesting or sort of unvesting, if you will, some of their equity, and then they get paid that out on a retention base over time. Right?
Which is separate from an escrow, which is to protect that the reps and warranties are correct.
Yes.
I guess maybe this question for Jacob, who's between the two parties of an entrepreneur or a acquirer. If you can address valuation terms that you see showing when there is a competitive versus an exclusive M&A agreement. I mean, clearly, you know, there's a value to you as an entrepreneur to have more than one party in conversation and not signing the exclusive that Jessica alluded to. And where do you see metrics diverge on a talent acquisition where there's a couple of parties involved?
Yeah, I'd say that having time scarcity or competition involved in the process actually it more helps the deal get done as opposed to increasing valuation by an order of magnitude. It creates, we're trying to build a technology product that helps people kind of do this more automatically, but we've seen that when you have other people talking to other people, from my point of view, I used to work in VC as well. This is also like a venture deal. Like no deals happen unless you have to do the deal, and there's a lot of pressure to make it actually happen. So having another party out in there, whether or not you're at the same stage, potentially, having conversations and kind of it's an artfully jockeying. Really, from my perspective, helps a deal get done. But I haven't seen it, skyrocket terms because most of the larger serial acquirers all have really good comps on the market, and so no one's going to go way over or way under just because of where the market's at. That said, if you get acquirers outside of traditional technology who are less practiced in this sort of craft, you can start to see some other kind of outlandish, larger terms that may not be within the comps of traditional tech buyers. But I'd say more than anything, as opposed to jockeying for price, jockey just to get it done.
Okay. Yeah, one in the back there. Yes.
Yeah. How do you handle the tension between the team who's going to get a nice retention package and the investors who are going to get less than their last round of valuation?
So the question is, how do you handle the tension between the proceeds paid to investors in the deal, and the contribution that's going to be made to the employees pursuant to offers and so forth?
I was in this room about 2 years ago on a panel, probably sitting in this chair next to Mike Brown, who used the F word in reference to the investors in this situation. So when we make an offer to a company, we make an offer to a legal entity, and it's their job to accept, reject, or negotiate. I've talked to a lot of or VCs who think that the three of us don't play fairly when we make these offers, and I'm like, that's your problem. You're a legal entity. Tell us if you don't want it, you don't have to accept it. But I view that as a company problem, their governance problem they have to figure out amongst themselves.
Yeah, and I would just say it really varies. So if you're talking about a company, and we've bought companies like this that was like seed funded with 500K, you're probably talking about a situation where they're going to get their money back and then some. If you're talking about a company that raised, double-digit millions, and like the product didn't take off, and every now and then you actually have the VCs reaching out who will say, like, listen, I know this much went in, but like, we're running a process, we're open to talent stuff. And so sometimes you actually have the VCs somewhat acknowledging at this point they may just be trying to do right by the founders and make sure they find a good fit. And of course they have a fiduciary responsibility to price optimize to the extent they can. But I actually think, like you were saying, no one's twisting anyone's arm here. Like, we make an offer, we talk it through with the founders, and ultimately that board makes a decision.
And what I would add is, like, one of the first questions, well, as soon as it becomes clear that we're interested, eventually I'm going to start talking to you about your cap table, right? Like, who are your investors? When did you take in money? And then as I begin to sort of like sharpen my thinking on where we are in price, and we have those conversations, I'm going to start asking you, so like, where are your VCs in this? Like, where is their head as it relates to kind of this situation in my offer, right? Is it a non-starter? Because like, we can part friends, and I'll be curious to see how your company continues to evolve, but like, let's not waste each other's time. It is the CEOs and the board's sort of thing to manage. My preference is to be very upfront. I don't think, when I'm articulating an offer, I'm articulating an offer both to the cap table and the retention piece that we've talked about in a very upfront way. I don't think I have to do that. I'll let the lawyers in the room tell me if different, but because the retention pieces are an employment relationship between those individuals and our company, right? But instead, I'm taking the sort of the very upfront, path and saying, like, these are the components, right? And there are definitely times where VCs are looking at the retention piece, going, okay, there's more money on the table. And it's my job to sort of be like, no, not for you. Like, stay away. And we manage that tension, right? Like, hopefully there's an open communication. There's been a lot of trust that's built up at that point in time, and we'll manage that tension. But I would bristle at the idea that we're not playing fair. Indeed, like, I think we're playing very fair with it.
One other thing. So it's directly related to how much money you raise and from what type of investors you raise. If you've raised just simply too much money where being able to pay a fair amount back or even a piece of that back to investors, it's just not even possible, you're kind of hamstrung. You're in a spot where everybody's gonna be unhappy. And also the type of investor. If you raise money, from what we've seen from the typical venture investor, they're going to be pretty hawkish and pretty excited to be involved in the process, as opposed to raising money from potentially an angel investor who's an individual who's happy to get money back and wants to kind of have another chance to invest. And so you're going to have different perspectives from different investors at play. So I'd say the lower the amount you've raised, the better, and just think it through on who.
Okay, let's jump to onboarding. So we've now gotten through the deal, and I've got a team that's going to be joining one of your esteemed companies. A couple things. First, what am I going to see? What's the process look like? How is it going to be for me for the first couple of years? Are each of you respectively going to still be involved in kind of overseeing how we as a team are doing, et cetera? I'm just kind of curious about how that works. And then secondly, I hear from others in the Valley that founders and CEOs of startups can often be very independent and autonomous. And I'm curious how that dynamic works well within these kinds of larger organizations. In particular, I often hear from companies that say, look, we're fine selling to those guys as long as we can just continue to do what we want without anyone intervening with us, right? So given that dynamic, obviously that's not going to work, but given that dynamic and that as maybe the initial thought process, how have you been able to deal with that on a going forward basis?
I would say, kind of similar to what I was saying before, getting to know, especially the founders, because they are probably the people you're going to put in these roles of influence and leadership, and they're probably going to have management responsibility with their team still. Getting to really know them and making sure the executive team or the heads of engineering and product think that they will be great leaders in the company, and then specifically talking about what they're going to go on and lead. Like, that is so important. And when we talk about getting to know the team and evaluating the talent, yes, that's technical talent and interviews, but that's also, are these the right types of leaders to bring into the company and have running something for us? Which includes an evaluation of, will they be engaged? Are they going to check out? Can they work in an environment that might be more structured than what they're used to? And then again, just trying to set them up for success. So just to give like one example here, I mentioned a deal we did about a year ago of a team called Cabana, and we set them up to work on this specific initiative around cards. There's 7 people. So you had an engineering leader and a product leader as co-founders, a designer, and 4 engineers. And like 4 months after we bought them, they launched that first product initiative. And we pulled one of the co-founders named Jeremy onto a diligence effort for a new deal. We were buying Crashlytics. And in that deal, he had a chance to like work more cross-functionally and also work on something that was both mobile and more infrastructure related, and really shown himself to be a strong leader in the company, and was promoted from a senior engineering manager to become a director of all of mobile engineering. And then like several months later, now has been promoted to be a senior director running much of our consumer engineering efforts. And so that's like 1 year. And this is, I think, a good example, because if you set talent acquisitions up correctly, and again, this was talent, plus we were leveraging some of their technology, but we weren't continuing their product. But if you put them on a specific effort and you empower those leaders and give them a shot, I think that's one of the deals that I'm really proud of that you don't actually hear a lot about, because it wasn't that public externally, but internally, we set those founders up to like really succeed and have a lot of impact in the company. And that's the stuff that I think actually ends up mattering for long-term retention and getting like value out of those teams.
Eric?
So Jessica's talked a lot about sort of making sure that you have this alignment on vision and what you're going to be doing. And I that couldn't be sort of more well said and more important, right? Which is, like, we talk a lot about, and it's, the terminology is different, but the theme is the same, which is we talk a lot about quick wins, right? We're Yahoo, we have our challenges, there's no room for empty oars, like everyone. So we talk a lot about quick wins, and that tees you up for success externally, like, oh, look at what the Lexity team did once they arrived at Yahoo, like 2 weeks later, right? And it tees you up for success internally, which is, wow, okay, right? Like, the impact that they had was near immediate, important, thoughtful, all those sorts of things. Like, that's critical to what we do. And it's not to say that we don't sort of miss it or things don't slide. Like, and we will eventually, at first we're having those thoughts on our own, right? And then we will eventually sort of, I don't want to say pull back the curtain, because it's not like ta-da, but we will begin to sort of talk to you about those sorts of things. Like, here's what we think you should do in the first 15 days, the first 45 days, the first 90 days. And we're checking in on those, right? Okay, it slipped. This isn't the end of the world. Like, why did it slip? What can we help you to make sure that that doesn't happen again, right? Like, what problems can we help solve for? At the same time, like, are you resourced properly? Have you had, like, in the worst, like, have you had people leave? Or do you need more resources to achieve it? Like, we're checking in on all these things to assure success, and that's value creation, right? I mean, what we are doing on some level is, the way I think of a talent deal is we are sort of, rather than we're striking a little bit earlier in the acquisition, in your development process, we're striking a little bit earlier and taking on some of that risk, and we think we can take some of it off the table too, right? Because, we have systems in place, we have HR systems, but we have all that stuff, and you can focus on the problem.
The only thing I would add on the point of autonomy, I think most talent deals, frankly, there's not going to be a ton of autonomy to run and do your own, because we're buying the talent, we're not buying a product. But that said, for our bigger and product deals, we often are hearing from entrepreneurs that they want autonomy, and sometimes we want to give it to them. So an example this year is the Waze acquisition that I did that Aaron would have done had he not quit. Waze is running largely independently, and they wanted it that way, we want it that way. They've got this wonderful community of users, which Google has struggled to get in certain areas, and we didn't want to interfere with that. So they're running very separately. We're doing a lot of data sharing on the back end, but that's largely through APIs, and so functionally they're really independent. And so I think there is room, even at big companies, and I'm sure it's the same at Yahoo and Twitter, to figure out ways to maintain some independence if the situation is right.
So we're doing the same with Tumblr, right? So there are those moments where sort of you decide, like, I don't know, the announcement when we announced Tumblr was we promised not to screw it up. Remember that? Like, and so like there is this moment of like, hey, like let's let them run things independently. I would say that is probably, for teams of 5, 10, 15, 20 people, that's probably not the route to success, right? Like getting sort of just plunked over there and go do your thing is probably less the route to success, and getting pulled into a team that is equally passionate about the problem and taking a collaborative approach is really sort of the route to success.
And just a little bit pivot on that is, we talk to a lot of buyers outside of tech, and a lot of these guys maybe have giant insurance companies or manufacturing companies or hotel companies, and their core business is not software, but they realize they need to have software and mobile to be really great. And so that's actually an opportunity for a relatively small team to come in and take a very large leadership role in building out technology. So last week there was an announcement, Live Nation, $5.5 billion a year revenue business that throws concerts, just bought a mobile team through us, which was awesome. But those guys are now running their mobile engineering teams, their mobile product teams, and those guys are like over the moon because they get to use have the distribution and the resources to do their craft in a much larger platform than before. So depending on what you want as a founder and where you want to go, that's just kind of a different edge on it.
Yeah, I would just add, as we talk about that spectrum of is this talent or is this a business or a standalone product where we also value the talent, that's where I think autonomy probably starts to function more on that scale. And I think for us, Vine is probably the analogy to some of the other ones you've heard, where we gave that team quite a bit of autonomy to continue building a product. But I think the exciting, maybe the intersection of trying to give teams autonomy where that's appropriate for the business, but also put them in roles of influence. Like you just gave an example where the entrepreneurs maybe are continuing to build that existing product, but also have influence more broadly. I think that's exciting, and that makes sense in a lot of cases where the talent or the leadership is especially brilliant.
Okay, you have me sold. I want to do a deal. I don't have a great into any one of you in particular, and I go to Total Access events and try to meet you there. But if I can't do that, what's the next best way to try to get noticed by you in your massive influx of requests for meetings and so forth? Any thoughts?
Well, we are all in this room the lucky folks that are in Silicon Valley, where you're probably one introduction away from all of us. If you don't already know us directly. And you can use your boards for this, you can use your advisors, you can use your lawyers, you can use other people that you can meet within the company. Like I mentioned, actually going through engineers and product folks who are aligned with what you're working on. I think that's a really effective way to the extent you can get in touch with them. And then I think for teams that are outside of Silicon Valley, or perhaps watching remotely, I think actually what you're doing is really unique and really important for the broader ecosystem.
Yeah, thanks, Harold, for teeing me up on this. This is Exitround infomercial time. No, essentially, yeah. I started this company because I was at Shasta Ventures and saw a dynamic where there are a lot of great people and great teams, and they were having a difficult time connecting with the right people within larger organizations for an acquisition conversation. And at the same time, these guys who all have very specific mandates looking for specific companies are kind of limited to their personal networks, to inbound coming in and the research they may do, but they may not see everything either. And so what we thought was, hey, can we build a technology product that can match the characteristics of what someone wants with the characteristics of what someone has. Think of an analogy of a dating site. You have two people that have certain characteristics and preferences, and through just matching algorithms, you can put them together. So that's what we created, and we see ourselves as a way of providing efficiency between that. And the way we do that is by enabling the buyers to come in and set different targets for exactly what they're looking for. So they may be looking for very specific things, whether it's a SaaS business, infrastructure business, mobile design business, whatever, and they can set a number of characteristics. And as companies in our marketplace come in, we're able to send them to them in a very kind of low-touch, non-spammy type way, and it's specifically what they're looking for. So, I mean, that's exactly the problem we're trying to solve, Harold. So.
That's great. Okay, any other questions now? We're going to open it up. Yes?
Can you talk about something that hasn't gone well? After an acquisition.
Can you talk about something that hasn't gone well?
Yeah, I'll give an example. I'm not going to talk in the specific, but so I've been at the company, like I mentioned, almost 5 years, and had a chance to see Twitter grow from a smaller startup to the company that we are now. And so along that way, we also kind of grew up as a corp dev team and figuring out how to do this stuff right. And like anything, I think we've seen our fair share of like mistakes. And also what we've tried to do is really institutionalize our integration process. And we actually we don't have an integration team, so the same person that's working on the deal, like me, is then trying to set the team up for success with integration. And you pull in a bunch of people to help on that, and so you have a cross-functional team of people from HR and IT and facilities and legal and whatnot to help you. But one thing we do is we run, for every deal we do, that sponsor and the corp dev team and everyone that makes the case and has this conviction around we should do this deal for these reasons, here's the value, and gets executive sign-off and board approval, that same group, corp dev and the deal sponsor, 30 days in has to represent and do a check-in, how's it going? And that process is not about pointing fingers or casting blame. That 30-day check-in, that's about catching stuff early, because as you do bigger deals, and the folks at Google and Yahoo can speak to this because you guys have done things at even bigger scale, you're never gonna know everything. And so having a dedicated integration team that can catch things quickly and have an escalation path, and for us, we use these check-ins as a way to like really quickly be like, you know what? We bought a team that's in a remote office, they're outside of headquarters, so we don't have quite as much of a touch point. And we realized one part of that team didn't have a lot of clarity around their mandate and around their like actual roles. And there was quite a bit of confusion, and that was causing just anxiety and a sense of like that team just like culturally wasn't super well integrated. And so our job was to catch that really early and then send a team out like the next week to like run a whole 2-day seminar, talk about like the goals and things like that. The other thing I've seen, 2 other times I think we've learned from mistakes. One time we did a deal and we really split up a team. We thought like, let's match them against what we think our highest priorities are, and that happens to be spread amongst a bunch of different initiatives. And what we learned, that team ended up doing really well over time, but in the short term didn't have a lot of momentum and didn't have clarity around that like single mandate and that roadmap. And so when we make the case that there's all this value to buying a team, which is in addition to what you would get from just hiring, turns out if you split them up and put them on a bunch of different initiatives, it's hard to realize that value. And that seems obvious, but you kind of have to learn this as you go. And the only other thing I think I've noticed over time is you want to make sure you have this clarity over mandates and roadmaps that doesn't have internal charter conflict, meaning making sure the initiative you're putting this team on is not already occupied by an internal team, and that the internal team they're going to work most closely with or join up with was empowered and like had some ownership and influence in the process, so they're walking into an environment where they're going to be like greeted enthusiastically and embraced by all their teammates. So that's kind of what we've learned along the way, and that's partially why we run 30-day check-ins, 6-month look-backs, and 1-year look-backs to like vocalize all of that and then make sure we like adjust our process as we go.
One question that through the process, I'm constantly asking the CEO or the CTO or like my main touch points is like, how is your team feeling? Right? Is your team excited? Like, And at some point they're going to start getting impatient, but are they excited, and like what do they want to do? Are they already kind of, and what I love to hear is, oh yeah, they're already thinking about the following ideas as to what they're going to do, which you can take that too far, right? It can be disruptive, but there is this level of enthusiasm that's reflected in that comment, right? So that vision alignment is sort of pretty important, and checking in and sort of doing course correction is very important. Where I have seen things go wrong is where you say, okay, you're going to own X, Y, Z, and everybody in the company agrees that they're going to own sort of product X, Y, Z, and then down they go, they're your desks, but having touch points at the technical and product level, like, hey, how do I solve that? How do I solve these problems? Who do I go to get this approved? Like, having those touch points is critically important. So setting up kind of setting up the, not just sort of reporting lines, right, but also setting up some level of cross-fertilization for ideas, for, break fix, for all these sorts of things that that go on in any team and any product development. The other thing I would tell you is where I've gotten myself in trouble is as you're working to get a deal closed, the deal kind of takes on a life of its own, right? And suddenly everybody starts, you feel the chorus of faster, faster, let's get this done, can we get this done before the holidays, can we get this done before the tax change, like there's some reason to get this done immediately. And what I tell our teams is fast is good. Fast is absolutely important. This is technology, right? The fast is good, correct is the goal, right? And when I say correct is the goal, that means, for our teams, that means if something isn't right? If something if it's not comporting, if the diligence numbers aren't adding up, don't look past it, dig into it, and figure it out, right? Odds are that's a 30-second call. 9 times out of 10, that's a 30-second call. It's the 1 time out of 10, or probably more likely the 1 time out of 100, where you discover something that you probably should have slowed the process down for.
Yeah, the only thing, Google does a similar approach to Twitter, I'm sure Yahoo, which is these kind of continually monitoring companies post-close, and we're very data-driven, so we're looking at things like retention rates and of employees, and are they hitting the milestones? Every deal we do, we have before it gets approved by our CEO, we have a list of what we call success metrics, and they're sometimes financial, sometimes they're HR, sometimes they're we're always measuring against those for a period of years afterwards and trying to course correct. And it's surprising sometimes how much of a role Corp Dev can play in fixing these things, just because there can be communication issues or things that we can just, not that we're magical, but we force light on a situation that otherwise might be ignored, and so we try to do that. The only thing I would add in terms of why deals sometimes fail or don't do as well as we hope is because after closing, and no one saw this coming, is there just a product direction change. We discontinue a product, and those people we had hired to do something specific, their mandate just isn't there anymore, and so we try to do the best and figure out what else they might want to work on, but that's obviously somewhat of a distraction for success.
Okay, last question right there. Yep.
Yeah, I appreciate your comments about lessons learned on deals that have closed. In ones that have gotten away from you, and that you look back in your careers and say, I really wish that had happened, what lessons did you learn from those experiences that have changed your processes as you apply them now?
So lessons from deals that got away.
I think one lesson that our CEO has taken away is that if there is a company that we think is a stellar company and it's growing quickly, and that but doesn't have financial metrics that a guy from the University of Chicago today could say it's worth X. Sometimes it's worth paying up for, and one that didn't get away is YouTube, but we were laughed at for at least 3 years after paying $1.6 billion for YouTube, and now I don't think anyone would be laughing, but that's one where there, at least at Google, there's this belief that some of these companies, you have to make a bet early on in M&A and believe that they're going to continue on. And so we have missed the boat on a couple companies where we failed to pay up for, and they're now super successful and way beyond our reach.
So Dave was teasing me about ways. And before Google, I was at a firm called Navtech, which is digital maps, if you know them. So I've spent more time than any healthy individual should spend in mapping. And at Navtech, when they sort of announced and said what they were doing, I went around, as a reasonably junior person, I went around pounding the table about how important it was to community-based mapping is the future. It's the future. I'm telling you, this is the cars that we're driving are all going away is going to be community-based mapping, which is probably an overstatement, but and you know, like it was, so when that announcement hit, not only because my friend here was rubbing the salt in the fact that I didn't do that deal, but there's also this like, whoa, like that one got, like, the lesson learned from me specifically is, like, I don't know how useful this is to founders, but in my day-to-day, I try to take a strong position on whether a company is useful for our company or not, right? Like, I try to be passionate about what you're doing internally, right? And so I work hard to spend time with you and sort of understand at the non-technical level, couldn't code a line of code if my life depended on it, what you're doing and the problems that you're trying to solve. And then, because then I can go and tell the story. And the ones that I regret are the ones that I didn't sort of tell the story right, or I didn't sort of get their ear right, and I didn't sort of do the advocacy quite right.
Yeah, everything that they've mentioned is really consistent with the stuff I've learned, having seen some deals come and go and not be able to win them all. I think what you've probably heard me emphasize today, which is one of my big learnings from deals over time, is just how much of an emotional sales process this is. And so like Dave was mentioning, you're always operating, it's probably much like investing, you're operating in an environment with uncertainty and with risk. And so you have to get comfortable having conviction about something, just knowing that like it's ultimately a bet and you may be wrong. And as those like bets get bigger and bigger, the fear of being wrong is bigger. But ultimately when you have that conviction, being comfortable, like really stepping behind something, putting your name behind something, and then running a very fast process where you don't sweat the small stuff and you optimize for convincing a founder of why working together is more exciting than working independently or working with someone else. And I think what I've learned over time is how much of that comes down to exciting people about chasing down some really ambitious vision, which is the same thing that got them excited about starting the company in the first place.
Well, that was outstanding. So let's please thank the panel. Thank you, everybody. Appreciate it.